My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. If you're new to the channel, my wife and I, we're down here in Austin, Texas, and we're looking to achieve financial independence and retire early off of our dividend growth portfolios. So my mindset, my investing strategy or methodology is really around dividend growth and long-term investing. And so when I'm reviewing the portfolios, I'm really reviewing it from my perspective as a dividend growth investor. And it's so interesting for me to see how different people all across the globe are investing in a dividend growth strategy. In today's Review My Pie video, we're gonna review 4 subscriber portfolios. The first is going to be from a 22-year-old here in the United States. The second, a 31-year-old here in the United States, a 26-year-old from Nepal, and a 52-year-old here in the United States. If you're like me and you grew up in the United States and you've maybe only been to different parts of the world, you may not necessarily know where Nepal is. And so if you look on a map and you go over here to Asia, just north of India is where Nepal is located. Now, I'm sure there's going to be some of you following the channel that are like, well, duh, everybody knows where Nepal is. But you know, there's people out there that have maybe never left their country. They don't even have a passport. And so for all of you that are maybe not aware or didn't know where Nepal is, hey, you just learned something new. And as always, everybody, I don't pre-script what I'm going to say in these videos. I don't review the portfolios in advance and kind of come up with a talk track. I'm reviewing them live for the very first time. And as always, everybody, I'm not a financial advisor. I'm just some random dude here on the internet. Don't take what I'm saying as professional financial advice. It's just merely for your entertainment. It's been so exciting for me seeing all the interest in the Review My Pie series. And I know there's a lot of you that really would like to have more one-on-one time and really be able to ask different questions specific to your portfolio. I've created a website where you can do that, where you can book time directly with me. So if you want to jump on a call or on a Zoom video call, we can do that. I do it a couple of times a week. If you want to do that, you can check out the link in the description below. One of the cool things of having a YouTube channel around investing is you get to meet different people and hear different opinions. And really, it's kind of an interesting thing, especially right now where there's a lot of excitement around Bitcoin, around GameStop, around these hyper growth companies and Tesla, NEO, and so forth. And I get asked a lot from a lot of you if I'm investing into cryptocurrency or if I'm invested into Tesla or ARK ETFs or anything like that. And just recently, a lot of you or a few of you have been asking if I'm invested into Dogecoin or if I would be interested or if I would in the future. And I think, you know, as a dividend growth investor who's kind of conservative and I guess you could say old school when it comes to my investing, I'm pretty conservative. I don't take a lot of risk. And I kind of think to myself, what would it be like if I invested into something like Dogecoin or something like that? I think, you know, I'm always up to try new things. And, you know, I'm kind of thinking to myself, what would it be like if I invested into Dogecoin and then I wake up the next morning? It'd probably look a little like this.
So, do you like weather?
You two know each other?
No.
Oh my gosh, that's hilarious. For those of you that have been following the channel a little bit longer, you probably will get the insider joke there more than somebody that's maybe new. Okay, cool. So the first portfolio is from Enrique. Enrique writes, "Hello, Jake. I started watching your videos recently, and I really enjoy the high quality content you put out. I would really appreciate any insight you could give me on my portfolio." Well, Enrique, I thank you so much, man. I appreciate the kind words. I'm by no means flashy. I'm kind of like I got a white belt in video editing and stuff like that. I'm, you know, by no means a pro. So you continue writing here, "I'm 22 years old and I just started investing more seriously, but I still have a lot to learn. I recently graduated with a computer science degree, so I'm able to invest around $500 a month into this taxable account after maxing my tax advantaged accounts." Okay, that's great. So tax advantage, you're probably, you know, you're maybe meeting your, you know, doing up to your employer match in your 401k, your Roth IRA, all that good stuff. "I want to build a steady source of passive income, which I can hopefully retire off of in around 25 years. Feel free to share my portfolio." Okay, awesome, Enrique. So I appreciate you sending this over. I think, you know, 25 years is a long time. When I talk about financial independence and retiring early, there's kind of a few things that come to mind. I think of financial independence as many different layers. What my wife and I are trying to achieve is financial independence. The retire early part is kind of, well, that's up for debate. We're still going to pursue other passions. We're going to travel. We're going to do other things. And, it's not like we're just sitting on the beach drinking martinis all day. That's not how we view early retirement for my wife and I. For a lot of people in their early 20s, when they think about retirement, they think about, the people that they know that are in retirement, right? They got gray hair. They don't move as fast as they used to. They have different habits or hobbies, and, it's maybe not so appealing. For me, the early retirement piece is kind of optional. And what the most important thing is the flexibility and the freedom to do what I want. So let's take a look at your portfolio. Your portfolio is up over 127% over the last 5 years. This is not including the reinvestment of dividends. You have just under 50 holdings. You have a good, healthy dividend yield, a starting dividend yield. This is much higher than the S&P 500, for example. So you're beating the S&P 500 both on growth and on your current yield. So this is really great. And you don't have an expense ratio, so that means you don't have any ETFs. You have your portfolio set up into 8 slices: technology at the highest, with consumer, healthcare, finance, real estate, industrials, utilities, and telecom. Let's take a look and see what you have in technology. In technology, you got your heavy hitters. You got Apple, Microsoft, Visa, MasterCard, and Texas Instruments. I really like how you have your portfolio set up with the target allocation. Now, if your time horizon is really 25 years, and you're like, you know what, I'm very confident 25 years is the time when I'm looking to tap into the dividends. I'm not going to be reinvesting the dividends. This allocation is actually really good. If you look at Apple is yielding just under a 1%. For, if you were to buy Apple today, you're getting less than less than 1% on the current yield. Microsoft is just hovered right around 1%. Visa is about 0.5%, Microsoft as well. Texas Instruments, on the other hand, is yielding, right around 2.5%. It goes up and down. And so this is a good target allocation with your goal of 25 years. And the cool thing about M1 Finance is as you get closer to retirement or closer to that, your financial independence, and when you're looking to no longer reinvest the dividends, you can then adjust the target allocation accordingly so that it meets your goal based off of your time horizon. So I really like your technology slice. I think for your timeline, it's really good. Let's take a look at your consumers. You're up 66%, just above a 2% yield. Okay, so this is definitely a growth-oriented portfolio. This is great. You got Pepsi in here. You got Starbucks, McDonald's, Home Depot, Nike, Costco, Clorox, Disney, Procter & Gamble, Kimberly-Clark, Coca-Cola, Altria Group, every single one of these companies. This is so great. Okay, so you got some high yielders. I think, you are spot on, Enrique. Like you are doing exactly what you should be doing, in my opinion. If your time horizon is 20 plus years, you are doing exactly what you should be doing, in that you're skewing more towards growth, right? A Starbucks, a Costco, a Nike, and then you also are having high yielders in here in Kimberly-Clark, Coca-Cola, and Altria Group, but they make a smaller percentage of your overall portfolio. Enrique, you are spot on. Anybody watching this video that has a 20 plus time horizon, take note of what Enrique is doing here, right? He has Altria Group and Coca-Cola. These are higher yielding companies, right? Altria Group has over a 7% dividend yield. Coca-Cola is hovered right around 3.3 to 3.5%, depending on the price, obviously. He also has Costco and Nike in here, similar to his technology slice, where these are paying they have a lower dividend, a lower starting yield, but they're growing. The dividend growth is growing exponentially faster than a Coca-Cola, a Kimberly-Clark, and a Procter & Gamble. This is a great portfolio. The names that you have in here, all of these companies are going to be here 10, 20, 30, 40, 50 years in the future. I think this is a stellar slice. Let's take a look at your healthcare. You got Johnson & Johnson, you got AbbVie, United Healthcare, Merck, Medtronic, and Pfizer. Okay, so I like this. I really like this as well. I think the only thing that I would maybe consider is Medtronic with your time horizon. I personally like Medtronic up here in the 20 range. United Healthcare maybe a little bit lower. Merck a little bit lower. I like Johnson & Johnson. Johnson & Johnson is like it's like an ETF, man. Like Johnson & Johnson, it's so well diversified in the products that they offer in the different business units. This is like an ETF of how diversified Johnson & Johnson is. It's like you're investing into 10 different companies. It's incredible. So yeah, I like all the companies in here. The only thing I would maybe consider is Medtronic's bumping it up a little bit, maybe lower Merck a little bit, something to that effect. But for the most part, it's great. Finance, you got JP Morgan, you got Bank of America, American Express, you got T. Rowe, Aflac, Maine, and Wells Fargo. So you got a lot of traditional banks in here. I think this is fine. I think another one that you could definitely take a look at is SPGI, ticker symbol SPGI, the Standard & Poor's. I think it's really, really good. Definitely a growth one. T. Rowe is great. Aflac is great. These are all really, really great companies. Real estate, what do you got in here? You got Realty Income, American Tower, Prologis, Store, and Simon. Okay, great. So I really like Realty Income. American Tower has been taking, it's been pulling back recently. People have been asking me recently, hey, Jake, why is American Tower going down? I see this as a buying opportunity. American Tower is a great company. It's not going anywhere. It's a growth company. 2020 was a tough year all around for real estate investment trusts. Another good one that I like in addition to American Tower is Crown Castle, ticker symbol CCI. But Prologis is great. One that I would recommend. So you have quite a bit of retail here. So you got 30, 40, you got 55% into retail. This is the first thing that I would encourage you to reconsider is you have a little bit too much exposure to retail REITs. I think store is great. Realty Income is great. Simon Properties, yeah, I mean, if you want to keep it in there, great. Me personally, I would like to see something like a data center REIT, like Digital Realty Trust, ticker symbol DLR. So in my opinion, I think you're a little bit overweighted or skewed more in retail. And with a 20-year plus time horizon, I think you should skew a little bit more into growth. And these are not, your Simon Property and your Realty Income, they're not really your growth when it comes to 20 years. So I would definitely consider looking at a data center REIT. Let's see what you got here in industrials at 12%. You got Union Pacific, Lockheed Martin, Honeywell, 3M, Waste Management, love to see it, and you got Caterpillar. These are great. Every single one of these are in my portfolio, and looking at the target allocation, I think this is fine. I mean, Union Pacific is great, Lockheed Martin, Caterpillar, yeah, this is absolutely fine. Utilities at 5%. Okay, great. You got Nexar Energy, you got American Waterworks, Southern Company, Duke. Man, Enrique, it's like you've been following my channel or something. Like this portfolio is so great. Nexar Energy at the top, great. Duke, Southern Company. I really, I'm trying to think with 30 years, like, yeah, I love it. I really like your portfolio. Holy cow. You got your telecom, AT&T, and Verizon. The only thing that I would do here is I would bump up Comcast and I would lower AT&T and Verizon. I would make, in my personal opinion, with 20 years, I would put Comcast at the highest. I would probably flip Comcast and AT&T. That's my opinion. With 20 plus years, the beautiful thing or the great thing about M1 Finance that I absolutely love that's so much different than any other brokerage is the reinvestment, the DRIP, the dividend reinvestment plan here is you're reinvesting the dividends. If you have it on auto invest, it automatically, so your high dividends, your AT&T, it doesn't get reinvested automatically into AT&T directly, but rather what M1 Finance does is it automatically reinvests into your overall portfolio that is underweight. So that dynamic rebalancing is what is so great, especially if you're going to invest for the long term. And that's why I don't personally think it's a bad thing or a negative thing to have an AT&T or a Verizon in a portfolio like this, because especially with M1 Finance, because the dividends from Verizon and AT&T are getting reinvested into your other growth companies. It is amazing. Before M1 Finance, this was a lot more complicated, right? With M1 Finance, it's really great. Enrique, I absolutely love your portfolio. I think for your time horizon and what you're looking to do is amazing. This is so, so great. Thank you so much for sending over your portfolio. All right, the second portfolio here is from Jacques. I believe I'm pronouncing that correctly. I believe it's French. I think the English translation is Jacques. And the reason why I know that is because I just Googled it because I hate saying somebody's name wrong. So Jacques writes here, "Hi Jake, I'm a big fan of your channel, especially your Review My Pie series. I love to be featured and I think my portfolio may be a good opportunity for you to talk about an investment strategy that I haven't seen you talk about much. Rather than picking individual stocks or focusing on dividend growth, I prefer to entirely use broad-based ETFs and simply ride the market. My long-term goal is to have the option to retire at age 41 with 1 to 1.2 million. I may keep working because I love my job, but the idea of being able to travel the world, give back to my community through volunteering, or just work part-time really appeals to me." To give you a little background on me, I'm a 31-year-old single guy living in Dallas, Texas. So not too far from you. I work an 8 to 5 job where I make $115,000 plus up to 20% bonus based on the performance of my company. For most of my adult life so far, age 23 to 28, I worked on paying off student loans, paying off a car loan, bad purchase, and building up my emergency fund, similar to the Dave Ramsey plan, BS 1 through 3, baby steps. In the last 2 to 3 years, though, I've really focused on investing. Right now, I'm investing 2% of my salary in my company's Roth 401k to get the match, $115 per week into a Roth IRA and $800 per week into a brokerage account, both with M1 Finance. The Roth and brokerage account are identical. Both are 65% in the S&P 500, 20% in the US mid cap, and 15% in the US small cap ETF. I really like this passive approach because I don't have the time or energy to research individual companies or worry about when to buy and sell them. I realize that my dividend yield is pretty low, but my goal is really as much capital as possible. Would love to hear your thoughts on this approach. Okay, so Jacques, I think this is great. So you mentioned a lot in here, and shout out from Austin. So you're just a little bit north of me. Okay, so what you're talking about is maybe a little bit more around the traditional FIRE movement. So for those of you that are maybe a little bit unfamiliar, the FIRE movement, Financial Independence from Retire Early, it's about really investing into low-fee, broad-based index funds, and you're amassing enough money so that you can reach your FIRE number. And essentially what it is if you have $40,000 in expenses a year, you're going to need 25 times 40,000 to reach your FIRE number, right? And there's different levels of FIRE. There's fat FIRE, there's lean FIRE. And so what it sounds like what you're doing or you're focusing on is kind of the traditional FIRE movement. And so I would encourage you to research a little bit more around the traditional FIRE movement because that kind of sounds like what you're doing. But I think, looking at it from my perspective, if you were to never sell your shares and just live off of the dividend income from your ETFs, I'm going to kind of look at it from that perspective, but also kind of keep in mind that maybe even the traditional FIRE movement may even be better suited for you. So let's take a look at your portfolio. In your portfolio, you're up 90%. And I think one of your questions was, because I talk about investing into individual companies as well as ETFs. I've shared a video on this in the past around, investing in individual companies versus ETFs. I personally do both. I invest in individual companies, but I also invest in the ETFs. I really like ETFs because they're truly passive, right? Like you're going to get average market returns depending on which index you follow, which index the ETF is invested in. But for me, I'm okay with that. I don't always have to beat the market. That's not my priority. The priority for me is controlling what I can control, and that be my expenses, staying out of consumer debt, right? Not buying that brand new BMW, and looking for new ways where I can make more money. Those are the things that I try to focus on. But having individual companies or just having ETFs, you can achieve this type of strategy or this, reaching financial independence through dividend investing just as well with ETFs than you can with individual stocks. So with ETFs, I think it's important to understand that, There's pros and cons to both. What I'll do is I'll leave a link in the top right to a detailed video around the differences between ETFs and individual stocks for dividend growth investing. I'll leave a link there. You can check out that video if you're interested in that. But as it stands for these type of ETFs, I think these are fine. I think it's important that you understand that depending on your goal, if you never want to sell your shares, it's going to take you a very long time to achieve enough cash flow or generate enough cash flow from your investments with these type of ETFs. These are not really focused on the dividend or the dividend growth. Now, if your goal is to invest into these more growth-oriented ETFs, and then once you reach your goal of 1 million, for example, rebalance, so sell out of these and reposition into higher yielding, dividend ETFs, you could most definitely do that, right? There's a few things that you have to consider, the tax implications that come into play there. There's a few things, but that approach could work very, very well. What it sounds like is you make a good amount of money, you make over 100 grand, you're single, but investing is maybe not your top priority. It is a priority for you, but it's not something that you want to watch and follow on a daily, weekly basis. So I think going the ETF route is absolutely a great way to accomplish your goal. But what I would encourage you to do, the number one thing is ask the question, what is the ideal situation for you in the future? Do you want to invest into growth now, sell, and then reposition into dividend stocks for passive income? Or do you want to slowly grow up high quality dividend ETFs today and not sell into the future? So that's the question that you have to ask yourself. There's really no right or wrong answer in my opinion, but it really comes down to what's right for you. When it comes to these ETFs, and when it comes to ETFs in general, I really like focusing on low fee ETFs that are focused on quality. Maybe they have a benchmark. They're looking at companies, specifically when it comes to dividends, that they're tracking, or the methodology that they're using is they're tracking an index where they're looking at companies based off of their dividend growth, their payout ratio, or their track record of dividend payouts. So that's something to consider when looking at these. Just generally, I think these are all great ETFs from iShares. They're tracking an index like the S&P 500. I don't think anyone could go wrong with that approach. So I think that other video that I shared around the differences between individual stocks and ETFs will help you a little bit more when it comes to making a decision what's right for you, individual stocks versus ETFs. Thank you so much for sending over your portfolio. The next portfolio here is from Gopal from Naples. He writes, "Hello Jake, your videos are fun to watch, and seeing others' portfolio, their strategies, and holding based on their age and standing in life is exciting to see. I am Gopal, a 26-year-old Nepal investor. I was in the US for 3 years, 2 years study plus 1 year's work to study, so I was able to create an M1 Finance account." That's true. You do have to be here in the US to be able to create an M1 account. "Initially, I was only investing on cryptocurrency. Lately, I've been investing in individual dividend yielding stocks and growth stocks. I've been back to my country, Nepal, and starting a company here. Because living cost for me here is around $300, I am planning to invest anywhere between $500 to $1,500 per month regularly by dollar cost averaging. My goal is to be able to live off my portfolio in 10 to 15 years, which is return of around $1,000 a month. Because I'm involved in the tech field, I have a higher chunk of investments in technology companies like Apple, around 13%, and I also have Unity, and I think Unity and Unreal have a duopoly in the game engine market." I actually agree. "My primary focus is on business and investing. However, I'm doing side hustles to create more streams of income like Instagram, podcasting, and YouTubing. I would love you to review my portfolio." Down here, you write here, "My questions would be, I am less on index funds. Should I play it safe? Also, should I be investing more into growth stocks?" Okay, well, Gopal, thank you so much for sending over your portfolio. Let's take a look here. So your portfolio is up 17%. Whenever you see this, if you use M1 Finance and you see that it doesn't go back all the way for 5 years, it's probably because you have a company in here that just recently IPO'd. So if you have a recently IPO'd company in here, you're not going to see the full 5 years. I don't know why it does that, but that's the reason why it does that. So you have a low expense ratio, you have a 2% dividend yield, you have 46 holdings, you got it broken up into passive income and large companies. Let's take a look at your passive income slice. You have it broken down into 8 slices: tech, real estate, finance, consumer, healthcare. So this is kind of like your standard dividend growth portfolio that you would generally see. So technology, 35%. You got Apple, Visa, MasterCard, IBM, Microsoft, and you even have a tech sector specific ETF. Yeah, this is fine. I think Apple is fine, Visa, these are all great companies. It's important to note, right? Apple and Visa are fundamentally different than an IBM or Oracle, right? These are more of your larger, slower growers. But, companies like Apple, Visa at the highest percentage there is fine. You did mention that your time horizon is 10 to 15 years. With 10 to 15 years, you could even have IBM a little bit higher if you wanted with that time horizon. So I wouldn't personally feel comfortable saying, hey, have IBM at the highest, but I think you would be okay with that time horizon bumping up IBM just a little bit. That's my opinion. With real estate, you got STORE, you got NRZ, Realty Income, Welltower, and Simon Property. You have a lot into retail. You're really heavy in retail. I would encourage you to reconsider, the allocation that you have here. I would encourage you to also take a look at, with a 10-year time horizon, take a look at some public storage units like Public Storage, Extra Space Storage. Those storage unit ones are really, really good. They yield right around 4.5%. They're growing decently year over year, but with a 10-year time horizon, I personally really like them. I also really like industrials. I like STAG. STAG is one of my favorite monthly dividend REITs. Ticker symbol STAG. Really, really good one. I think it's like a little bit over a 5% dividend yield. Welltower is a healthcare REIT. If you wanted to look at another healthcare one, this is another monthly payer, is ticker symbol LTC. That's also a really good one that I like. It's a really good monthly dividend payer. So there's some good ones in there. I would definitely take a look at a few of those. You don't have to go after just your cell towers, your data centers with a 10-year time horizon, but I would encourage you to reconsider having so much in retail. Let's take a look at your finance slice. You got JP Morgan, American Express, Wells Fargo. I think this is fine with a 10-year time horizon. JP Morgan, your traditional banks in here, I think that's fine. Consumer, this is a smaller yield for a 10-year time horizon for consumers. You got Disney in here, Costco, Home Depot, and Nike. So that's probably the reason why. I personally, with a 10-year time horizon, if you plan on here's the golden question. If you plan on never selling your shares, you probably want to lower Disney. Disney's a great company. It's a great growth company, but it's not going to benefit you as a dividend investor who is relying on the dividend cash flow or passive income in 10 years. So I think bumping up Pepsi, lowering Disney, lowering Costco would probably be a good idea, assuming that you never want to sell the shares. If you want to sell the shares, it's a different question. But if you don't want to sell the shares, healthcare, Johnson & Johnson, Procter & Gamble would go back into your consumer slice. Same with CVS here, but you got AbbVie, you got Johnson & Johnson, you got VHT. These are great. Let's take a look at your telecom. You got Verizon, you got AT&T. I think these are both fine. 80-20, yeah, you could do 80-20. It means, I think me personally, I like having it 50-50. I think they're both great companies, but it's personal preference. Utilities. You got VPU, NextEra Energy, Southern Company, Dominion, and Duke. This is really, really good, actually. So I like this. I would encourage you to lower NextEra Energy, maybe to, it's not that crazy. It's only 18%. But what I think Duke and Southern Company are really, really good. I think Duke and Southern Company are probably the best ones for a 10-year time horizon. And also what I would encourage you to maybe consider is bumping up utilities. I think with technology, with your time horizon of 10 years, I know you're in the technology space. Same here, right? I work in tech here in Austin, and I think it wouldn't be a bad idea to maybe, with a 10-year time horizon, lower tech, bump up utilities, bump up consumers, maybe even bump up healthcare as well. It's just my opinion. Industrials, you got Union Pacific, Waste Management, love it. General Dynamics, love it. 3M, love it. These are great. Waiting 10 years, I personally, I would, this is my opinion, I would switch 3M and Union Pacific. I think with your time horizon, you're not going to sell your shares. You're better off, in my opinion, with 3M at the highest there. Okay, so I think your portfolio is good here with the passive income slice. Let's take a look at your larger companies. You got Berkshire Hathaway. This one doesn't pay a dividend, but it's fine. I mean, you could always, it gives you flexibility. You can do other things with it. Kraft Heinz, yeah, I mean, Kraft Heinz is fine. I mean, it's more so like if you're going to retire here in the next couple of years, it's not necessarily a big growth company. McDonald's, yeah, McDonald's is great. Unity Software is great. They just went IPO. That's probably why your portfolio is not going far out into the past, is because of Unity Software. You got Apple in here as well. Again, you got Bank of America, Google, and you got Uber in here. Yeah, I think these are, you're invested into really great companies, right? And the thing that I like about this is you work in the technology space, right? And I think this is so great. I think everyone could benefit from this. So something that I would encourage everyone watching the video is kind of look and understand, okay, what do you know particularly well? Say, for example, you work in an industry where you know more information about that industry than your average person, right? Let's say maybe you work in in pharmaceuticals, right? If you work in pharmaceuticals, you understand that industry much better than the average person. And so what you can do is, if you work in the pharmaceutical industry, you could then really double down on the healthcare industry and get really in detail into healthcare, right? Or let's say, for example, you work as a construction person, you work at a manufacturer of some material company. You could then invest into a specific company that you work with as a supplier, or somebody, something that you have maybe a little bit more exposure to than somebody else. The main thing that I'm getting at here is your circle of competence. Whatever your circle of competence is, really focus on that and really try to, get into companies that you understand. Because the reason why that's important is when the market goes down, right, and you see this crash, when you see the portfolio go down, you need to have the conviction in the companies that you're invested in. And if you know more about them because you work with them on a daily basis, for example, then you're going to be better. You're going to be better suited than somebody that isn't maybe as aware with the business or the industry. So something to kind of think about as you're building out your portfolio. And I think about that because Gopal here said that he's in the tech industry, and I think that's really unique because he probably understands technology companies a little bit better than your average person. But that can apply to every industry, to all of you that are watching the video. So something to think about. Gopal, thank you so much for sending over your portfolio. It's so cool to see that somebody out there all the way in across the world is following the channel. Thank you so much. The last portfolio here is from Sabrina. Sabrina writes, "Hello, Jake. I just discovered your channel on YouTube and I absolutely love it." Thank you so much, Sabrina. I really appreciate you saying that. I was wondering if you could take a look at my portfolio setup. Not sure if it is video worthy since it's a new portfolio with $0 invested at the moment. I'm 52 years of age, looking to retire probably within 10 to 15 years. And I believe, Sabrina, you sent me another email as well. I think you have two portfolios. You have a growth portfolio and a dividend focused portfolio. Your first portfolio is more focused on growth. It's up 172%. I have 21 holdings, just over a 2% dividend yield, 0 expense ratio. So you're destroying the S&P 500 on both fronts, on the total performance as well as on the dividend yield. So you're beating the S&P 500. And there's little surprise there because you're more skewed here in tech. You have manufacturing, healthcare, finance, and then the list goes on. Let's take a look at your tech slice. You got Apple, Microsoft, and Intel. Yeah, I think these are great companies. I think, when you look at the weighting, when you have a 10 to 15 year time horizon, this really is a growth focused slice here with Apple, Microsoft, and Intel. Now, if you're looking to retire or leverage the dividends beyond 59.5, I would hope that this would potentially be in a Roth or a tax advantaged account, a Roth IRA, so that when you're getting the dividends, you're not paying taxes on the dividends. And for example, if you were to say, Apple has gone up, I'm not getting the dividends that I need, so you could sell out of them and pay zero taxes in a Roth account. For example, it's something to consider, especially when your time horizon is into, after, 59.5. In my opinion, it's a no-brainer to take advantage of tax-advantaged accounts. The next slice here is manufacturing. You got Kraft. Kraft is Kraft, Coca-Cola, McDonald's. These are more consumers, but when you look at it, just at the companies as a whole, I like Coca-Cola, I like McDonald's, I love Waste Management. Kraft Heinz is fine. What I would encourage you to understand is, why do you have Kraft Heinz in here, right? A lot of people, when they're new to investing, is they go and they look at a dividend screener, and they screen by company size, by maybe market cap. They look at the dividend yield, and they say, okay, this company has the highest dividend. That means it's the best company, right? That's not always the case. A lot of it could be based off could be a yield trap. With Kraft Heinz, they were paying a massive dividend a couple of years ago, and what happened? They were forced to cut their dividend, and so that big juicy dividend that you were getting before just got cut in half. So really understand and ask the question, why? Maybe you really like, their Kraft Heinz ketchup. Who knows? But I would still encourage you to understand and ask the question, why are you investing in Kraft Heinz, or any company for that matter? Toyota Motors, I personally don't invest in any car makers for when I'm relying on the dividend. There's a lot of great car makers out there, but for me personally, I haven't. I don't have any car makers in my portfolio. Toyota as a company is a great company, but the ones that I really like are Coca-Cola, McDonald's, and Waste Management. Healthcare, you got AbbVie, Pfizer, Merck, and Johnson & Johnson. These are all really, really great. And you mentioned this is more focused on growth. If you want growth, you're probably going to want to bump Pfizer down a bit. Pfizer is not really growing as quickly as AbbVie or Johnson & Johnson. Finance, you got, your traditional banks and USB, Bank of America. If you want some growth, take a look at some insurance companies, right? Take a look at Aflac. You could take a look at some investment companies like T. Rowe Price. They just increased their dividend here not too long ago by a massive amount. There's some others that you could take a look at in addition to your traditional banks. Telecom, you got Verizon and AT&T. Yeah, these are your standards. You got your entertainment and Disney. Disney's a great company. I think they're going to reinstate their dividend here this year. It probably won't be the first. They pay biannually, so it probably won't be the first wave, but the second half of the year, I think they would reinstate their dividend. If not, then probably in 2022. But I think they're going to do it here in 2021. Let's take a look. Computer services, you got IBM, okay. You got transportation, you got UPS, and you got real estate, you got Realty Income. Yeah, so, this is fine. I think, there are some clear growth companies in this portfolio, and there's some clear dividend companies in this portfolio. And despite that, on average, your portfolio is doing tremendous. And a lot of that has to do with the allocation that you have into tech. So I think, as I mentioned, with the Kraft Heinz, maybe the IBMs, these really high dividend payers, really ask the question, why do you hold them in the portfolio? And if you know the why, if you know your why, go for it. Keep them in there. But if you're like, maybe I'm not quite sure. I thought, just because they have a high dividend, they were a good investment. That's where you want to be careful. If you're a new dividend investor, you don't want to fall into that trap that high dividend means by default good, right? That's not the case. in most cases. Let's take a look at your dividend focused portfolio here. This is your extra cash. This would be your passive income portfolio. Has a higher starting yield, 3%. You got some expenses. This is just ETFs. So you got SPHD. This is a monthly dividend payer. This one's fine. It has a little bit of a higher expense ratio. The companies in this ETF, they're okay. I wouldn't say that they're great, but I think that they're okay. That's my opinion on SPHD. I wouldn't discourage anybody from investing into SPHD, but I would definitely ask the question, okay, if you're benchmarking SPHD versus another ETF, what's important to you, right? Is the monthly payments a priority for you? Okay, go for it. But understand like what's being held in these different ETFs. And the important thing with ETFs, yes, the expense ratio, but probably the most important thing with ETFs is understand how they're picking the companies that are in their index, right? Every ETF follows either an index or has a methodology behind how they screen different companies that go into their ETF. So important. HDV is a good one. HDV, it's a low fee one. It's a high yielder. HDV is really skewed in oil. So if you've been holding HDV here these last couple of months, you've made out like a bandit. It's run up a lot here this year. VYM and SCHD are my two favorite high dividend ETFs. These are absolutely great. These make up the largest positions in my portfolio. I absolutely love VYM. I love SCHD. VYM is the high dividend equivalent, but for non-US. This is international. VIG is fine. VIG is more so kind of like your S&P 500. It's like you really need a long time for the dividend to compound and to grow. Like it's very comparable just to the S&P 500 in terms of the dividend growth rate and historical performance. So as a whole, I think these are all really, these are great ETFs. There's good exposure. There's good, target allocation. You don't have it all in, skewed into one. I think these are absolutely fine. Sabrina, thank you so much for sending over your portfolios. Thank you so much, everybody, for watching the video. Today was a little bit harder for me. I woke up kind of with a pretty bad headache, so this is why the video is coming out a little bit later today. I was almost fearing that I wasn't even going to be able to create the video. Just simply, I don't know what it is, just change in the weather or something. Been battling a pretty bad headache today. So if you've been watching the video this long, thank you so much for watching, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.